Well, as the Finance Minister says, South Africa owes a lot of people a lot of money. Debt remains a massive problem in this country. But in a year where money is too tight to mention, Minister Tito Mboweni has even offered some tax breaks. And perhaps surprisingly, in today's budget, it was announced that the corporate tax rate has gone down from 28% to 27%. The financial situation is dire after the economy contracted by more than 7% last year, unemployment soaring above 32%. But Mboweni says there are signs of hope, such as growth expected to pick up this year. Let's bring in a few different voices now. We're joined by the SACPs Dr. Mashilo. He is a Central Committee member, the head of capital markets at Intellidex. Peter Attard Montalto, expected to join us shortly, and the director of the Centre for Economic Development and Transformation, Duma Gqubule. Thank you, the two gentlemen that are with us thus far. Let me start by asking you if you do feel more or less hopeful after today's budget speech. Let's start with you, Duma.
Well, there isn't much in the budget for most South Africans because, what I noticed is that the Finance Minister didn't talk about this 500 billion rand fiscal stimulus because many of us have been trying to show that there was no 500 billion stimulus. According to my calculations, it was about a quarter of that amount. And what I found really puzzling in the speech today is that he said many times it is not an austerity budget. But if you look at the documents that accompanied the budget, all of them had austerity written all over them. I'll start with non-interest expenditure, which declines in nominal terms by about 39 billion rands and 0.8% a year over the 3-year period. Government consumption spending declines for 3 consecutive years, 0.1% this year, 1.7% the next year, 1.6% the following year. Social grants, as your anchor was saying earlier on, I was horrified to see 36 billion rands cut from social grants over the next 3 years. And the one that really puzzled me is that they've allocated 11 billion rand to job creation, and they say that brings the allocation to 100 billion rand. That is not correct. So last year in the medium-term budget, they allocated 12.6 billion rands to the employment stimulus. This year, they're allocating 11 billion rands. That is 23 billion rands, as opposed to the 100 billion rand that was promised by the president in the stimulus speech on April 21. So there are very many things that I saw in this budget that shows that the public sector wage bill, for the first time, the government is conceding that they cannot achieve the savings that they expect of 145 billion rands from the wage freeze alone. There will be cuts in employment for public sectors. You will see less nurses, less doctors, and less public servants. That will erode the quality of public services, which are already in a desperate situation.
All right, so if I can sum up what you're saying, we'll get into it a little bit more. The cuts to important spending are irking you. Alex, let me turn to you. I mean, do we accept cuts when we're really in a difficult situation, when we're so indebted that just paying the interest on that debt is more than we spend on social grants? So the situation is going to get worse and worse unless we get out of debt. In a situation like that, can we accept some cuts?
We are in a crisis. I agree with the sentiments expressed by Duma. And if you look at the budget from an expenditure point of view, that is government expenditure as a percentage of the gross domestic product, we have cuts for the next 3 years, from now as the first year of the medium-term expenditure framework up to the outer year. The national government departments' budgets are also going through that cut. Provinces will remain stable for the 2 years, 2022, 23, 2023, 24, but there is a cut in the first year. So there is a slight increase in the first year, and I wish to explain some increases. There is some stability in terms of municipal budget, but as the finance minister has said, where there is a positive adjustment, that positive adjustment is financed by a cut from another baseline program or entity in the budget. So in other words, you do not have growth in government expenditure. For us to overcome our debt crisis, we need to understand why we are indebted. If you have the state that is pursuing an economic policy where the state is not investing in the productive sector itself. Because you can talk about debt, but debt in a capitalist economy is systemic. The entities, in fact, private enterprises that you hear are investing here and there, most of them are borrowing money from the bank, and they recover from the investment that they made where value is added, and that's how they are able to increase the capital that they have. So how does the state do so? If you have a state that is not pursuing public sector or public investment in the productive activity, and at the same time, you can talk about that. There is that cut in corporate tax from 28% to 27%. That means 1% is gone from the tax revenue, for instance. Yes.
All right, thank you. So you're talking about where the spending is going. Duma concerned about the budget cuts. Let's bring in Peter Attard Montalto from Intellidex. Peter, you missed the first question, which was, the finance minister saying there's hope here. Do you feel more or less hopeful after today's budget speech?
Good evening. Sorry for the delay. So I think the problem is that this is now sort of a price to perfection budget, if you like, from a macro stance. A lot of things have to go right in terms of growth, in terms of revenue. The commodity price story has to continue for some time. You have to have zero nominal increase in wages. And if all that happens, we're going to get this year earlier of debt stabilizing and then turning lower. But there is a lot of risk in the system from all those factors. Also on the grants point, I think is crucial to make. It's not, I think, the appropriate policy to have a real cut to grants in the coming year. 1.6% grants increase versus inflation for lower income deciles will be around 3.5% or even a bit higher than that. And there's a risk of a political pushback on that. So a lot of risk in the system, a little bit of wiggle room as well. They put in a big contingency reserve for next year based on the possibility of some more vaccine spending. But when you take all that together, we're still in a pretty bad place overall, even with this somewhat rosier outlook on the foundations for this path.
Peter, this is interesting because from an investor perspective, the traditional view is that investors like budget cuts. They like spending cuts, especially on things that aren't productive. But you're saying actually markets wouldn't have minded even more being spent on social grants. There's almost an acceptance after what happened in Greece, like the finance minister spoke about, people's pensions being cut, that is not always the way to go. Do you agree?
Well, I'm not entirely sure if your average bond investor is there sobbing about social grants, unfortunately, but I see it as a big political risk. And also a question of efficient expenditure. What do you want to be spending money on as the budget? You want it on a social wage, you want it on health, you want it on education and infrastructure. We're seeing cuts come into this budget beneath it because government can't spend the money fast enough on investment as well. And this is really the problem when you're not having zero-based budgeting happening. You're getting this inefficient sort of very odd allocation and odd allocation of cuts to make the budget add up. And really the promises of just doing National Treasury and DPE next year in terms of zero-based budgeting misses the point. We need the big spending departments where you're comparing, all different sorts of expenditure across the board to have this mindset of what is the priority. And when you don't have that discussion, things like real cuts in grants will fall out of the bottom. So it comes from, I think, this sort of inappropriate conversation at the cabinet level of what's really important in the budget.
So Duma, the finance minister kept on saying this is not an austerity budget. It sounds like you just don't buy that.
Yes, all three of us have explained parts of the budget where there's going to be cuts. And the other thing that puzzled me is that government has been talking about this infrastructure fund, 100 billion rand infrastructure fund. We finally saw an allocation of 4 billion rands for this year, but that allocation is 0.8% of GDP. It's not going to drive an increase in investment over the next year. So what you've seen is that the ANC's Economic Transformation Committee has forecast a 130 billion rand decline investment this year. And National Treasury is forecast a decline in gross fixed capital formation this year. So it puts paid to this view in the government that they're embarking on this infrastructure-led recovery. when the figures from the ruling party and from the National Treasury show that there will be a decline in investment this year.
Yeah. Alex, do you agree with that? Because it's incredible. I mean, the whole COVID-19 recovery package, a huge part of that was infrastructure. Maybe the SACP view is different. Infrastructure can create that enabling environment for investment. You want more productive spending. But do you think we're lacking even in the infrastructure spend?
There has been no change in the figures presented on infrastructure. I think for the past three budgets, the budget adjustments last year, the budget speech in February, the two budget adjustments, the medium-term expenditure framework outlined in the medium-term budget policy statement have been referring to a single figure of 100 billion rand. And there is a 10-year period attached to that. Moreover, there is a blended finance mechanism attached to that. So in real terms, you have what Duma has correctly characterized as you are unlikely to have an investment-led growth. By the way, there are macroeconomic implications of a cut in state spending. If overall state spending goes down 3 consecutive years, what do you think will be the impact, macroeconomically speaking, on growth? The National Treasury envisages a 3.3% growth this year and a decline in the growth rate next year and a further decline in the growth rate in the outer year of the medium-term expenditure framework. Surely, there is no way that will resolve unemployment problems. To resolve unemployment problems, and even to finance the repayment of debt plus interest, as well as the associated cost, you need an economic policy that drives an inclusive growth. It is from growth that you are able to draw resources to reduce the debt. But if you cut the instruments that you need in order to grow the economy so that you can pay the debt, yes, the debt will grow to 88% and even more in 2024 and so forth, as the National Treasury is saying. So there are implications. We do not need, but I must say that the Minister of Finance was impressive today. He is known as a hardliner. I know him also as a hardliner. But his presentation was sympathetic. However, the figures contained in the various documents accompanying that articulation are not sympathetic. That's why there was even no reference to the public sector wage dispute resolution. In other words, while inflation, according to the Minister of Finance, will be rising around 4% on average, public sector wages will remain standstill, medical aids are increasing. There are just so many increases. So we are likely to see a conflict increase also in that sphere.
All right, so Peter, I mean, two issues have been raised here. The one is the elephant in the room, which is the wage negotiations with government workers. We know how that's gone for the past 2 years. Is that also a risk, as you say, in investment terms? And then also, do you agree with Alex that actually to get out of low growth, we need to spend more?
So on the public sector wage issue, the Treasury, I think, still remains very optimistic that they can indeed push through zero nominal increases, so flat for 3 years. Maybe they can do it for another year. I think politically doing that for 3 years when inflation is going to be growing at 4.5% per year each year, it's certainly not going to be possible in the second or the third year. They're very confident that they're not going to get potentially the case even heard by the unions in the Constitutional Court. There is a big question of if the unions do actually have access to the Constitutional Court on that point. And in any case, I think the Constitutional Court would probably side with National Treasury. And then there's the bargaining council issue, which remains to be resolved, and there will ultimately be a political decision. But if you shift from zero nominal, so flat wages, up to, say, inflation compensation over 3 years, you're spending an extra 130 odd billion versus what's been penciled in today, which is obviously a huge amount of money, which Treasury would then try and cut from elsewhere. So we have to think about the fallout risk from this. In terms of the additional spending, I mean, we want a huge amount of additional spending in the economy from the private sector if we actually had the PPP reforms, for instance, that Treasury has promised now in an appendix in the document, but unclear exactly what the manoeuvring going on behind the scenes on that is. But as the SARB has shown very clearly, and as we can see in the composition of spending today, still huge inefficiencies in spending, a lot going to SOEs. The SARB continues to say that the fiscal multiplier is zero or even negative. And so I think it's far from clear that it would be positive having additional spending from government. But no, we should certainly see more and hope there is success for Operation Vulindlela, for instance, which ultimately is about trying to kickstart private sector spending into investment, whether it's from onshore investors or offshore investors.
Duma, are public-private partnerships the way to go? And if not, I mean, we've all been very critical tonight, but what would you have wanted him to do, given our debt situation, given that it's dire, given that I think there is a consensus around the world it's not a great idea to start printing money or things like that?
Well, let me just say something, Francis, is that if you look at the budget for the last 20 years, every year, PPPs is less than 2% of, it's the smallest portion of investment in the public sector investment. It's a small line item that is not even worth looking at. These PPPs have not been successful over the last 20 years. And why should they be successful now? And then secondly, as Alex said, how are you going to have an investment-led recovery when the major reason for the collapse of investment over the last few years has been a public sector investment strike? Public sector investment has been collapsing. Eskom, Transnet, general government through the austerity and so forth. So unless we have a plan to fix the balance sheet of Eskom, which we haven't heard about for the past 3 years, Transnet and the state-owned companies, we are not going to see that investment-led recovery.
Alex, we've got time for one more, so let me end with you. Why is it not working? It sounds wonderful that government doesn't have to spend all our tax money, that it can partner with the private sector that has got the cash. Why isn't that working?
Where does the private sector obtain the cash? If you go at the Johannesburg Stock Exchange and read a lot of private sector firms' books, they borrow money. And then they take the money that they have borrowed, they invest it in the production of goods and services. It is in the production of goods and services where new value is created. And from that new value, private sector companies increase their revenue and capital accumulation, so to speak. Now, if you have a state that refuses to do the same and relies on the private sector, the trajectory will not change. It will stay the same. So the state has to think about ways it can change its expenditure pattern, orientate its expenditure towards the productive sector, so that they can participate and reap the fruits or the rewards of value creation in the production and trade of goods and services. You cannot leave that to the private sector alone while you pursue policies that cut corporate spending. As things stand right now, South Africa's tax revenue will be financed by a shrinking base of earners the top strata of the working class or the middle classes, and at the lower level that has shrunk quite completely. So for us to lead by example, the state has to invest. And if it does not have the cash in its hands, it must do like the private sector is doing. Every time you read newspapers, you listen to radio or watch television, and you hear about private sector acquisitions and investment, the reality is that much of that money is driven by loans, because loans are systemic in a capitalist economy. It depends what you do with the loan. Do you advance productive debt, or do you not advance productive debt and complain and cut spending? By the way, the cut in expenditure in the state is not going to resolve our unemployment crisis. It is not going to resolve our growth crisis. That's what we must be thinking about. What is the way forward?
Okay, Peter, we've got time just for your response on the public-private partnerships failing. And I'm really interested in this because it's often presented as the solution by government for government and the private sector to work together.
Well, there's been a huge amount of work done by the World Bank and others into National Treasury on how to reform these. There's a lot of best practice to learn globally on how not to structure them, where you don't want, the private sector charging, a couple of £1,000 to change a light bulb in a hospital, those sorts of PPPs. But there is a huge demand to fund these things from pension funds, from the stock of savings in South Africa, which I think our SACP friends has ignored, that there is a huge stock. It's not just about borrowing the money from the middle of nowhere. It's about investing the hard-earned savings of South Africans into these productive assets going forward and leading growth that way. We should remember that around 68% or more of investment currently is done by the private sector, not by the public sector. Moving the dial there is going to be so much easier, and we can see that going forwards. Eskom can't currently borrow substantial amounts of money in the market for new renewables, but I have clients falling over themselves waiting to fund new renewables in South Africa, and about $150 billion of capital to fund that is very easily available. So ultimately, it isn't about one or the other in total, but it's about unlocking where there is money waiting to come, and the quantums are simply much larger for the private sector.
All right, an interesting debate to have. Thank you so much for your time. We have to leave it there. That was the SACP's Central Committee member, Dr. Alex Mashilo, the head of capital markets at Intellidex, Peter Attard Montalto, and Duma Gqubule, the director of the Centre for Economic Development and Transformation.